Okay, let's dive right into this explainer. Today, RTX Corporation is stepping into our valuation gauntlet. As an investment analyst, my goal here is to stress test this $258 billion aerospace and defense titan against the absolute greatest investing frameworks in history. We're going to strip away all the market noise, look at the cold, hard data from their latest financials, and figure out what the numbers are actually telling us about their stock price. We'll be evaluating RTX through 6 distinct lenses to see if its $199.25 price tag is truly justified. We'll run it through Warren Buffett's moat analysis, Peter Lynch's growth metrics, Ben Graham's strict deep value checklist, a rigorous DCF model, and some alternative valuations before we nail down a final recommendation. All right, let's kick things off with a quick company snapshot and see how it holds up under the Warren Buffett lens. So, the Oracle of Omaha demands a wide economic moat, right? Well, RTX is perfectly balanced across both commercial and military sectors. In Q1, their revenue was up 9% to $22.1 billion. And if you break that down, Pratt Whitney brought in 37% of sales, followed really closely by Collins Aerospace and Raytheon at roughly 31% each. That kind of diversification, that is the absolute bedrock of their business model. And honestly, RTX breezes right through the qualitative parts of Buffett's test. Get this, they're sitting on a massive, record-breaking $271 billion backlog. I mean, that provides unbelievable earnings visibility. It's a true economic moat. Add in an adjusted EPS of $6.29, an 11.36% return on equity, and operating margins expanding to 13.69%. But the real kicker for Buffett? They're generating a whopping $7.9 billion in free cash flow, what he'd call pure owner earnings. But, and there is always a but with Buffett, he absolutely demands a strict margin of safety. If we look at their historical earnings consistency and aim for a high free cash flow yield, his rigid criteria would probably only trigger a buy around the $120 mark. So yeah, RTX is a phenomenal business with an undeniable moat, but at $199.25, Buffett would definitely pass or just hold. Let's shift gears and look through the Peter Lynch lens, where we're hunting for growth at a reasonable price. Lynch loved companies where the underlying fundamentals were quietly accelerating way faster than top-line sales. He'd probably categorize RTX as a stalwart, riding a massive cyclical defense upswing. And here's exactly why. Their operating income is growing at 21%. That is literally more than twice as fast as their 9% revenue growth. This expanding operating leverage is arguably the single best argument for owning the stock right now. They're growing organic sales while increasing their headcount by only 1%. Deep cost discipline at work. Because of that sweet operational leverage and a really healthy PEG ratio dynamic driven by strong institutional backing and internal productivity gains, valuation models like Ticker project a target of $218 by 2030. For a Peter Lynch-style investor looking at a stalwart with solid upside, that's roughly a 19% total return from recent lows. So in Lynch's book, this earns a solid hold or maybe a cautious buy. Next up, the toughest test of them all. Benjamin Graham's deep value checklist. Graham cares about hard assets, historical stability, and basically buying a dollar for 50 cents. Running RTX through his defensive investor checklist, they easily clear the size hurdle with that $258 billion market cap, and their earnings stability is rock solid. Plus, their dividend record is just incredible. They have paid a cash dividend every single year since 1936. Just think about that. But Graham's final test is all about having moderate price-to-earnings and price-to-book multiples. To find his exact intrinsic value, we actually have to do a little bit of math. We use Graham's famous formula, the square root of 22.5 times earnings per share times book value per share. Now, book value isn't explicitly in our base data, so we safely derived it from their 11.36% return on equity and 6.29 EPS, giving us an assumed book value of $55.37. Well, when you crunch those numbers, Graham's strict formula values RTX at exactly $88.51 per share. Deep value investing requires a serious margin of safety, and at almost $200 a share today, RTX is trading at a huge premium to its book value. So for a pure deep value Graham investor, no way. This is a hard sell. Stepping away from the historical gurus for a second, let's dive into the raw mechanics of a discounted cash flow, or DCF model. We want to see what those future cash flows are actually worth in today's dollars.
Using the company's own aggressive free cash flow targets, we extrapolate a base case FY26 target of roughly $8.5 billion. We'll apply a standard 8% weighted average cost of capital, which is totally appropriate for a defense stalwart with manageable debt, and assume a long-term perpetual terminal growth rate of 2.5% to match broad economic expansion.
When we project those cash flows out and discount them back to today, our base case DCF gives us a fair value of right around $185 per share. And keep in mind, if we run a sensitivity table and bump up that discount rate or lower the terminal growth even a little, that valuation drops further. What this tells us is that at $199.25, the broader market has already priced in a lot of the current aerospace and defense cycle optimism. Let's quickly check out a couple of alternative valuation models, specifically looking at margins and dividends. When we stack RTX up against its peers for operational efficiency, they've made some incredible strides. Hitting a 13.69% operating margin means they've actually overtaken their prime rival, Lockheed Martin, who is sitting at 13.33%. That said, they're still significantly trailing highly efficient peers like Honeywell at 21% and Howmet at over 28%. So there's absolutely still room for structural margin improvement. Now, if we try to apply a dividend discount model, we run into a really fascinating capital allocation pivot. RTX pays a rock-solid 73-cent quarterly dividend, which yields about 1.46%. But a DDM falls a bit short here, because management is deliberately prioritizing massive reinvestment over pure dividend growth. I mean, they are deploying an astonishing $10.5 billion into CapEx and R&D for 2026 just to expand capacity for munitions, sensors, and new facilities down in Texas and Georgia. All right, it is time to bring it all together. Let's synthesize these numbers into our final verdict. RTX has officially survived the gauntlet, and looking at all our frameworks side by side reveals a pretty stark contrast. Momentum and growth models, like Peter Lynch's, see a path to $218 based on that sweet margin expansion. But our DCF model pegs intrinsic value lower at $185, while the ultra-strict margin of safety frameworks of Warren Buffett and Ben Graham demand way lower entry points of $120 and $88. Blending all these insights together paints a very clear picture. The fundamental business, it's incredible. A $271 billion backlog and operating income growing twice as fast as revenue are absolute dream metrics for an investor. But the primary risk here is the valuation itself. The market is paying a premium right now, basically assuming totally flawless future execution, all while RTX has to navigate that massive $10.5 billion CapEx plan that could temporarily squeeze their free cash flow. So here is our final recommendation. RTX is a fantastic, moated company, but as an investment at $199.25, it is a solid hold. The risk-to-reward ratio just isn't asymmetric enough for new capital right now. If you're a prudent investor, you probably want to wait for some broader market volatility to drag the price closer to that $185 DCF fair value before you initiate or add to a position. I'm going to leave you with this final provocative thought to chew on. As RTX pours billions and billions into new foundries and munitions capacity to clear out that historic backlog, will this massive investment permanently secure their dominance for the next decade? Or will the current defense supercycle cool down just as those brand new factories come online? Thanks for joining me in this explainer today, and as always, keep analyzing those numbers.